Saurabh Mukherjea, welcome back. Saurabh, I was just thinking that with Saurabh Mukherjea, we always discuss which is a good stock to buy, which is a good company to invest in. Is he there? I can't see him.
Yeah, I'm here.
Hello. So, with you, we always discuss which is a good company to buy, which is a good stock to buy, which is a good sector to think. My question is that Saurabh Mukherjea has created a good franchise called Marcellus Investment. You're managing billions of dollars. How can one invest in Saurabh Mukherjea now? I'm not going to give you money to manage. I want to invest in Marcellus. How can that happen?
Actually, Saurabh, let me quote him verbatim, because before you came on air, he was telling me, Asli chokka to Saurabh ne mara hai. Look at him, he is now managing billions of dollars.
And it's the faith of the Indian investor in the country itself.
That is all long talk. Tell me the reason. You are a smart stock picker. How can one invest in Saurabh Mukherjea?
So Marcellus stock, for better or for worse, is not for sale at the moment. Maybe 5-6 years out, maybe Marcellus stock might be available to the world at large. At the moment, it's owned by the employees by and large. And jokes apart, in all seriousness, whilst the employees own the company, without the Indian investors' faith in the country. And remember, we've been through three traumatic years, 2 years of COVID, now all this drama around Ukraine. But what's remarkable is the sort of unrelenting faith of the Indian investor in the country itself. FPIs come and go. The local investors stand strong, and that's what allowed us to build a business where we're able to run a company with 120 people managing 13,000 crores. All of that wouldn't have been happening if the local janta, the local public in India, hadn't believed in the country's economy.
We've built a wonderful franchise, my friend. It's just been such a pleasure tracking your journey as an entrepreneur. It's been such a pleasure. Compliments, sincere compliments.
Thank you very much.
Saurabh, have you got fresh inflows in this market volatility? I'm just trying to gauge it because the mutual fund folks are getting flows. Have you got fresh inflows when markets fell in March?
So we were getting around 100 crores a week for most of the last couple of years. When the war with Ukraine broke out, for a couple of weeks, it reduced to 50-60 crores a week. But over the last 10 days or so, we are back to the usual Marcellus number of around 100 crores a week coming in. And as you're saying, that's consistent with what we are hearing from the mutual fund industry. The local investor, the Indian investor, has been rock solid. We got FII flows till June, July last year. Our foreign client inflows did dwindle through the winter. Over the last couple of weeks, some of our foreign clients have been visiting India again. Amongst other people, they've met us. And my reckoning is, if the conflict in Ukraine doesn't escalate, I think foreign inflows will also start coming back for us and for other people through the course of the summer.
Amir Arora on the channel yesterday, and he gave a very interesting data point. And I know a lot of people come on channel and they just throw data at Saurabh. This is expensive, that is expensive. His data point was that in last couple of years, the profits for consumer companies have doubled, but the prices have tripled, which is there is a P expansion which has happened. Now for the first time, there is a demand impact and there is a margin impact. So he's making a case that the P multiples have to contract purely because of the expansion which has happened in the past, which has been higher than the earning expansion.
Right. So I think the first thing to realize is what drives stock prices is not earnings. What drives stock prices is free cash flows. And if you take the typical company that we invest in, whether it's in our Little Champs portfolios, where last week we opened it for inflows after 2 years, or in our flagship consistent compounders portfolio, whether it's in our small caps or in our large cap portfolio, what we have seen over the last 2 years, the last 5 years is profit compounding in India in well-run companies tends to be between 15 to 20%. So if it's a larger company like Asian Paints, Pidilite, profit compounding is around 15%. If it's a smaller company like, say, an Alkyl Amines or a GMM Pfaudler, profit compounding would be around 20%, right? But free cash flow compounding, which is the real driver of share prices, whether it's an Asian Paints or a Pidilite, large companies, free cash flow compounding 25%, even through the last 3, 4, 5 years. And then the smaller stocks, the Little Champs franchises, as we call them, free cash flow compounding is around 35%. So this difference, right, is big. if a company compounds, if a company as big as a Asian Paints or a Pidilite compounds profits at 15, but cash flows at 25, and it's the cash flow compounding which is driving the stock, optically, the PE multiple will look high because the P is not following E. The P is following free cash flow. So if I give you an extreme example, Astral Poly, over the last 10 years, profits are up 5x, free cash flow is up 100x, share price is up 100x. Right? And we spent a lot of time explaining this to people, that what drives share prices is not profits. Astral Poly's profits are up 5x in 10 years. Free cash flows are up 100x. You need to follow the cash, not the PAT. Follow the cash and not the PAT, and you'll make good money in India. Even through the current fiscal that's going to end today, free cash flows are up very, very strongly for almost all our investee companies.
Good morning, Saurabh. Through many interviews, you, for example, have told us, you have a research meeting on Fridays. You analyze the BSE 500 companies. You carry out, I think, 30, 40 forensic tests on them to figure out this cash flow. You've given us one idea, but tell us in recent times, what is it that you bought in the crash? You told us earlier that you accumulated more of Asian Paint and Pidilite, but what else?
So I think I might have mentioned before, we've also bought plenty of Dr. Lal. We couldn't make any logical sense of the share price pullback. As we just discussed, PE multiples don't drive share prices. So we bought plenty of Dr. Lal over the last couple of months. In our small cap portfolios, one area where we have to hold our hand up and say we didn't quite get it right is over the last 3 years, we've contended. We've in fact told your viewers on this program that auto and auto ancillary would do well. They haven't done well. And hence, over the last couple of months, we have pulled back from our auto and auto ancillary investments. A lot of that money has gone in the small cap portfolio into V-Mart. We've been holding V-Mart for 2 years. The shares haven't done much over the last 12 months even. But as the unlock proceeds, given the quality of V-Mart's franchise, given the way V-Mart has crushed working capital, I think if you look at Indian retail, barring Trent, barring West Side, we don't see anybody else managing the apparel business as well as V-Mart does. So we've loaded up further on V-Mart as we've reduced our auto and auto ancillary investments. And in our larger cap portfolios, we bought ICICI Lombard. We bought more of ICICI Lombard in our flagship portfolio, consistent compounder. So those have been the two areas where we bought two franchises which we had investments in the past, but we have ramped them up over the last couple of months quite aggressively, V-Mart and ICICI Lombard.
Okay. And so that's great to know. And incidentally, we did have V-Mart on the channel just yesterday. But Saurabh, the other question for you is, we talk in the morning, a day after Axis, new franchise, buying out Citibank's consumer business. Great ads today. The city never closes. Having said that, Axis is a company which is looking at M&As to plug holes in its franchise, right? It's done it with Max Life. Now it's doing it with Citi. Are you looking at it? What do you make of it?
Sure. So we have access in our Kings of Capital portfolio. Kings of Capital is our financials only portfolio. We've had it for around 2 years. Obviously, we've had some pushback from clients over the last couple of years as Access hasn't had the greatest of run. But we've persevered. We persevered partly because we've seen Amitabh build a great franchise at HDFC Life. We've also persevered because as we do ground level checks, and we have done ground level checks right throughout COVID on Access's branch network, on the people who have been joining the firm, the new people that Amitabh has brought in, our view has been that this man is turning around the Access franchise. He's bringing in good people. He's putting operational rigor. Given that they had spare capital, given Amitabh's track record, we banked that he will deliver. And we're happy to see the deal. We're happy to see the Citibank deal. It will take them 2-3 years to actually show us the fruits of that deal in terms of better ROEs. But given that they have surplus capital and what they seem to have acquired as a profitable franchise, we think it's the right deal to do. We're also quite keen to see more happening on the Access Max front, where nobody knows Banca and the power of Banca, i.e. selling insurance through the branch networks of a high quality private sector bank. I don't think anybody understands better than Amitabh. So we're keen to see more happening on the Access and Max front. Overall, given how few high quality private sector banks there are in our country, you can count them on the fingers of one hand. In fact, you don't even need the fingers of one hand to count high quality private sector banks. We think this is a space in which a strong player like Axis with what CASA ratio now approaching 45-47% will do very well in this incipient economic recovery.
Right. Sort of whenever we have you on air, the amount of tweets that we get saying that we're not interested in the ICICI Lombard Axis kind of ideas, get more like a Paushak from him. So I want to know what the hidden gems are in your portfolio. Anything of late?
No, so I think we discussed Paushak. We've continued building that position. I think as I discussed in our last interview, it's a controlled market. Barriers to entry are high. Whilst a couple of other larger companies do make phosgene in India, our reckoning is their commitment to phosgene, their capacity constraints in phosgene are considerable. And therefore, this is your only pure play private sector phosgene manufacturer. Phosgene is an essential industrial chemical, as essential as chlorine. Because of the Bhopal gas tragedy, our country has had a mental block about it. It is hazardous, but at the same time, it's essential. And therefore, we reckon Paushak is beautifully placed to make money. We are looking for more small cap ideas, but I will be honest, it takes lots of hard work and it takes 1.5 years of research to nail down a stock which you can invest in. Given that in all our stocks that we are discussing, we are committing hundreds of crores of capital to it, clients' money, my own money, my family's money, we're committing large sums of money to it. We've got to be very careful about these investments. So in a given year, you'll see us making 1 or 2 small cap investments and perhaps getting out of 1 or 2 small cap stocks. So V-Mart has been a little champ for us. Paushak is now a little champ for us. And whilst I appreciate the tweets that you guys are getting, it is hard to find small cap ideas with, sort of metronomic regularity. We'll try our best, but it is difficult. I'll put that disclaimer up front.
It is. But, since you're talking about your little champs, I want to know which are the little champs in the last 2 years. V-Mart, of course, is one that you talked about. But which are the other big candidates which really made you those big monies in the last 2 years?
So I think as we've discussed, repeatedly on your channel over the last couple of years, I think alkyl amines and GMM Pfaudler, we first invested in them 3 years ago. But over the last couple of years, they've made our clients a lot of money. In fact, if I look at our Little Champs portfolio in its entirety, in 2.5 years, we've more than doubled clients' money. And a significant role was played by alkyl amines and GMM Pfaudler. More recently, a company that we again invested in 2 years ago, Fine Organics, is coming through very nicely. We also have high hopes of Galaxy Surfactants. And if I look at the financial space, Aavas Financiers, we think is a lender that can make money for us. They've done well, but I think the real upswing in Aavas, given that they're well capitalized, well-run lender, the real upswing in Aavas will come in now that the unlock has happened and the economy has started recovering. But I think pride of place in terms of creating wealth for Marcellus clients should go to alkyl amines and GMM Pfaudler.
So, Saurabh, let's say if Asian Paints and Pidilite are your large cap champion compounders, GMM Pfaudler and alkyl amine, are they in that category, which is that these are long-term compounders?
So the main difference, right? I mean, leaving aside the obvious difference in market cap, right? Where say the GMMs and the alkyls are 1/10 the market cap of a Pidilite or an Asian base. Leaving aside that obvious difference, the main difference tends to be the institutionalization of the franchise. So in smaller companies like GMM, like alkyl, like Paushak, like Fine Organics, the dependence on the promoter is greater. Whereas in larger franchises like Asian Paints or a TCS, it's far more institutionalized, right? Where the family's taken a back seat and high quality managers, typically people hired from the IITs and IIMs when they are in the early 20s and then they grow to run the business. That institutionalization is far more advanced in our flagship investments in consistent compounders. One of the things we work on quite closely with our small cap investments is nudging them, prodding them, guiding them to institutionalize the business, encouraging the promoter to play the role of a capital allocator and handing over the day-to-day management of the business to high quality managers. It's not easy to do. These people are hard to find. Plus, it's hard for promoters to let go. But I think that institutionalization, if you ask me, is the fundamental difference between our little champs versus our consistent compounders.
Shift gears, Saurabh, and let's talk about a headline which in a sense will puzzle everybody when you read a headline like this. It is a Monday morning headline, which is, I'm not talking about Ukraine, don't worry. It is global bond yields have inverted, and when global bond yields have inverted, it means there is a recession coming in the world. A recession in the world is bad news for equities. Now, whether it is Asian Paints or Pidilite, or whether it is Tata Steel, or whether it is Hindalco, a recession is bad news. So when you are investing, and when the US sophisticated bond market is telling you that a recession is coming, how does one deal with this, and how should one approach, and how should equity investors approach it?
Sure. So just to sort of step back and think about it, right? We've been discussing a whole bunch of names over the last 10 minutes or so. If you notice, very few of them are cyclical plays, right? For obvious reasons, companies like Alkyl, like GMM, who supply raw materials to the pharmaceutical industry, they're not cyclical plays because the pharmaceutical industry isn't a cyclical play. But even less obviously, perhaps, companies like a Pidilite or an Asian Paints aren't cyclical either. So the first thing to realize is neither you nor I are experts in calling the economic cycle, and I've certainly made it clear to clients from the time we set up Marcellus that don't expect us to be timing the macro cycle or timing a commodity cycle. We have no expertise in that. I don't think anybody does out there. So timing economic cycles, commodity cycles has not been a clever way to invest in any country, not just India, and hence it's something we have stayed away from doing. Furthermore, if you look at the biggest challenges India has faced over the last 5 years, the last 5 years I wouldn't say have been exactly an economic boom in India. We've had GST, COVID, demon, and in spite of those hits, in spite of those repeated shocks to the economy, you've had these companies, Pidilite and Asian Paints, a Titan, compounding free cash flows at 25%. So if you can go through a rough economic patch like our country has done off and on over the last 5-6 years and come out with 25% free cash flow compounding, I'll happily take that. And last factoid, if you look at India, because we are investing in India, the job creation data is spectacular. So EPFO published this data 5-6 days ago. In the last 3 years, three tough years for India, India has created 32 million jobs in the formal sector. Right? These are formal job creation. This is EPFO. CMI is also validated the same data. The entire workforce of France is 30 million. The entire workforce of UK is 30 million. India has created as many jobs in the last 3 years in the formal sector as the entire workforce of G7 countries. That gives you a sense of the robustness, the resilience of our country, which is why I'm not going to lose too much sleep about the inversion of the yield curve in the United States.
Because if there is a bear market coming, technically, I'm just trying to understand the cycle part here, Saurabh, and I'm glad we're having this conversation. It's more like a macro conversation. When you see a recession or a bear market coming, a 25 to 30% fall, even more, can easily happen because equity also has this inherent nature which is called mean reversion. So what we're trying to understand from you perhaps is that, look, your approach towards individual stocks is great, but if it's a rising tide which takes everything higher, a receding tide will bring things down.
So in part, I sort of semi-acknowledged your point by saying 5 minutes back that auto and auto ancillary, we have ramped off our investments. We've reduced our auto and auto ancillary investments. Perhaps we didn't quite think about it in macro terms when we did so, Nikunj, but perhaps our pulling back on our auto and auto ancillary investments perhaps is an acknowledgement that the from a global perspective, perhaps not from an Indian perspective, from a global perspective, the best of the economic expansion is done. But at the same time, I would urge you to think about the fact that if I look at our own client base, the biggest fear is interest rate hikes, right? There's this constant sort of fear that interest rates chad jayega, and if interest rates hike, there'll be some pullback in the market. So it's very, very paradoxical. On the one hand, the American market is worried about a recession. On the other hand, the Indian market is worried about higher rates. And obviously, there's a contradiction there. The Federal Reserve is unlikely to pump rates higher and push America into recession. And at the same time, of these two, of the higher interest rates or a recession, I don't think both will kick in together. I think we'll get a mixture of the Federal Reserve nudging rates up by, say, 100 bips or so over the next 12 months. And at the same time, the overheated economic recovery that we have seen in the West, where American economic growth is running at some 4.5%, 5%, and a giant IT services company like Accenture is posting 28% revenue growth. It's unbelievable the rate at which America is growing. I think we will see a cooling of the frenetic economic recovery in the Western world, and we will get some degree of normalization in interest rates after COVID. Both of those are, I think, healthy corrections, healthy normalizations in the post-COVID world. Neither of those I think, should be used by people who are watching this to do tactical positioning of the portfolios, because I don't think that sort of investing works. So I'll partly concede the fact that the economic recovery in the West should slow down. It's been overheated. And the Fed has made it abundantly clear that there is a rate hike coming. So both of those take us to some degree of normality as we return to normal circumstances after COVID as best as we can, given the whole Ukraine scenario.
That's Saurabh Mukherjea there for you with the mind of a test player playing sometimes 2020 cricket, right? That's what he wrote in his book. Thanks a lot, Saurabh, for joining us live today on The Market. It's always great having your views.